This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on repurchase agreements and financing. I know we've talked about repurchase agreements in bits and pieces in the past, and even in some recordings, we had some bits and pieces that were a little bit bigger than others, but we have an entire chapter here inside of this book. What I thought I would do is provide you with the example that I give my students when talking about repurchase agreements. So bear with me here for just a few minutes and let's see if this example isn't worth it. Let's suppose that I'm just Jim, right? And you're one of my best friends. And I have in my possession, in my garage, a 1971 Chevy Corvette ZR2. One of those really rare Corvettes. And as my friend, you come and say, hey, my wife or my husband and I, we have our wedding anniversary this weekend. We want to drive down the coast and we'd love to borrow your Corvette. Can we have it? And since we're best friends, I say, sure, here are the keys and please don't drive it in the ocean. Don't drive it off the cliff. Please be careful. And give me a full tank of gas when you return. But then let's extend that to, let's suppose we don't know each other. And I still have this super rare car, and you would like the use of this car for a short time period. So you come and knock on my door and introduce yourself and say, hey, I see you have this really cool car in your garage. Can I rent it from you for a day or two? And I'm probably going to shake my head and say, you know what, renting, that doesn't sound very good. And I'd say, besides, what kind of collateral can you put up against it? I said, how about your house? How about a beach house? And you say, yeah, probably not. So I come up with this idea. I say, look, why don't you buy it from me today? And let's just pick a number, $100,000. And then you can have it for one day, and I'll buy it back from you for $101,000 tomorrow. I'll even let you have the title. And then before I hand the title to the car over to you, I start thinking, wait a minute, what if you crash it and you repair it and I don't like the repairs? So let's hand it to a third party, somebody that I trust, maybe somebody that you trust. And we'll see how important third parties here as we get through this slide deck. So now we have this agreement. I get what I want, you get what you want, but what you didn't know as part of this transaction is that I needed $100,000 today. So you provided me with a service and I pretended like I was kind of doing you a favor, right? So let's extend that now to, I'm a Jim, but I'm a financial institution and you're not my best friend or some stranger. You're just another financial institution out there. And I don't have a rare Corvette, but I have a Treasury security. And so the repurchase market works exactly that same way. Let's suppose I have this Treasury bill and I need some money. I need some capital today to either, pay my workers or meet my reserve requirements or finance the purchase of some other assets. And you're a financial institution and you have capital today. You have cash laying around. Maybe you're a municipality and it's April 15th and you've just collected $1 billion in cash. Now you have to save that for all of your expenses, but you have all this money today, so why don't you try to earn a short-term return on this? So we agree that I will sell you this Treasury security today. Let's suppose it's $100, and then I'll repurchase it again tomorrow. Let's just say it's $101, just to use the similar math as I did in the Corvette example. And so we're all happy, right? I'm happy because I have my 100 today. You have the Treasury today, and you're going to generate a 1% return by tomorrow on your extra cash, right? So that fits into not only liquidity management, but cash management. Now, the interesting part about all this is that if I were to have offered you 101 tomorrow, which you accepted, but if you glanced over in the Treasury market and you see that you could get the same kind of a Treasury security and the government would pay you 105 tomorrow, there's no way you would provide me with that capital, right? You would go buy a Treasury security, which you can do anytime you want, right? And so me, as this owner of the Treasury, I'm gonna provide you with the Treasury and you're gonna lend me this capital. I have to compete with the federal government. I mean, if the federal government is offering 105 and I'm only offering you 101, well, then there's no way you're gonna provide me with that capital. So the repo rates and the yields on Treasury securities, they have to be linked. right? So let's just summarize here. What was that? 2 or 3 minutes, maybe 4 minutes. Hey, I have what I want. You got what you want in this repurchase agreement. And you see how it works ideally is that I don't have to worry about you crashing my car. You're going to return that Treasury bill tomorrow to me because, I mean, how much damage can you do? Can you do to a piece of paper or or one of those ISINs? All right, so let's look at these learning objectives. Thank you for indulging me. I sure hope that helps going through these learning objectives. Actually, in my example, we've worked through some of these already. Look at that first one. Describe the mechanics of a repurchase agreement. Discuss some common motivations, and how about counterparty and liquidity risk? So embedded in my example, we've done a little bit of that. We're also going to do some calculations today. We'll talk about Lehman Brothers and Bear Stearns, collateral, and then we'll end with another calculation and a couple of slides on spreads. So let's go ahead and get started. This slide really is just a review of what my example illustrated. What are the mechanics? A money market instrument, right? Very short term. I mean, most of these are 1-day maturities, but there's no reason that they can't be 1 week or 1 month or, 20 years, right? We could agree to trade my Corvette in 20 years. I mean, we probably won't do that, but we could. Let's see. Sells securities to another party at a fixed price and agrees to repurchase it at an agreed future date and an agreed price. So it effectively combines two simultaneous transactions, right? A sell and a buyback, and then a buy and then a resell, or that would be called a reverse repo. So this is secured borrowing, and there's a good formula down there to determine the dollar amount of interest. So let's go ahead and do just a quick example. Let's suppose that we're a hedge fund. We own $10 million worth of some Treasury securities, and the fund is in need of capital quickly. So we'll use the Treasuries as collateral. There's another financial institution. Hey, there's my example, right? A local municipality with newly collected tax receipts. All right, so they want to invest overnight. So we do all this agreement. Suppose the repo rate is 5%. So if you do the math here, let me just go back to that formula. Look at that formula. So you have the principal times the repo rate. So, let's just do 100 times 5%, right? And then we have to adjust it for time. And so if this is 1 day repo, then we multiply that by 1/360th. That's the convention. I'm sure I told you guys this before, that back in the old days before computers, it was a lot easier to divide by 360 than 365. So we get 1389 for the total interest paid on that $10 million repo. Now here's an illustration of the mechanics of what happens. So notice you have on the left-hand side in purple, we have some institutions that need to borrow. And then on the right-hand side, we have some institutions that can lend. And, while we've listed hedge funds and mortgage REITs and banks and financial institutions over there as the borrowers, there's no reason that they can't be over there as the lender and vice versa. But these are pretty standard borrowers and lenders. And so look at the arrows, and let's just do the top arrow. So the hedge fund then provides the security to the dealer bank. Let's just take a pause here. Remember when I indicated that I was going to hand you the title to my Chevy Corvette, and I said, oh, wait a minute, how about if I give it to a third party over here, because I'm not sure I trust your driving skills. But now we're still going to hand it to the dealer bank because I don't want to worry about tracking you down tomorrow. So, the dealer bank and these clearinghouse organizations, they kind of act as the middle person. And so they provide the security over there. And then the $10 million flows through the dealer. And then tomorrow, then the securities and the cash just flow in the opposite direction. And so there's that $1,389. And look at the bottom there. Dealer bank charges a fee for intermediating the transaction. And there's another block point. You can contract term can be longer, could be 6 months or 12 months or 20 years if we really want it to. My original example did talk about some motivations for entering repos, and these should be pretty obvious, right? Cash management, and then I'm going to go right down here, liquidity management. I'm going to put those I'm going to block those into, I mean, they're separate, but they're pretty much related as well. Cash management, so institutions invest their surplus cash. And then, of course, the collateral encourages more lending. Incremental income, of course, you can generate income by, essentially kind of doing nothing, but you're providing a loan and you're going to be, kind of guaranteed that you're going to get that money back tomorrow. When I say guaranteed, I put my fingers up in quotes. Of course, this is not a guarantee, but central banks do this pretty regularly. Inventory management. I mean, there are lots of institutions, like dealers and traders out there who probably don't own lots of their inventory, and so they just finance the holdings in the repo market. Liquidity management. This is tied back to cash management, but it's unique in that liquidity management is going to offer us some diversification in the source of funds. And then, of course, there are short positions out there that allow any financial institution to take advantage of movements in when prices are falling, right? Short positions. But there's also the specter of having to cover short positions, and you can do this in the reverse repo. Here we've talked about these two types of risk. Counterparty risk, we know all about this from previous recordings. And we've talked about liquidity risk. We know this from previous recordings as well. Look at the bottom circle point there under liquidity risk. How do we manage this liquidity risk? I'm always a good question creator about managing risk. I ask my students these kind of questions all the time. Identify the risk and then tell me how we manage it. So margin calls, right? Reducing the repo term, high quality collateral, and then the use of haircuts. Let's take a look at a specific example. Of course, my fictional, I don't happen to own a 71 Chevy Corvette. I don't want you guys to think that I'm super wealthy here, but let's look at some real live transactions and some examples. So we all know about the 2008 financial crisis, Lehman Brothers. Lehman Brothers had lots of tri-party repos where there was the requirement of a third party. So JP Morgan Chase acted as the clearing agent for Lehman. And this is what we know about this time period, 2006 and 2007. We know that there was greater instability. I mean, it was percolating in lots of markets, but it was clearly percolating to a greater level in the repo market, resulting in substantially higher instability in not only in those repo rates, but in also, differences between supply and demand. There's that great example back in 2019 where the repo rate, which, for, 6 or 8 months was hovering, somewhere around 2%, maybe 2.1%. And all of a sudden it spiked up to, 9 or 10 or 11% because of, imbalances in supply and demand. So there are lots of reasons why there was instability. But why was Lehman Brothers unique, right? This instability was facing all of the institutions in the industry. Why was their situation so unique? And it all comes down to reporting. We've read about this before. We've heard about this before. So there was some type of an accounting rule that allowed an institution to classify assets that were loaned out as effectively sold. Notice that there are quotation marks in this sale. So what they could do is they could say, oh, we sold those, so we have all this cash, right? And then we would put together the financial statements for that particular day. Remember the balance sheet is, a picture on one day. And so after that one day was over, then we would go ahead and borrow again and do the whole thing, et cetera, et cetera. So look at the last arrow point. In the end, this maneuver left Lehman even more leveraged. All right, so you got this combination of instability in the markets and then more leverage So what happened was that, leading into the beginning of 2008 and then through the summer of 2008, JP Morgan had a pretty good relationship with Lehman Brothers and did not start imposing haircuts until the end of the summer, maybe in September, somewhere around there. And this was because of concern that collateral was not quite as liquid as JPM wanted it to be. And in fact, maybe valuation models were placing too high of a value on that collateral. So you got this combination of instability, illiquid markets and overvaluation. And so, of course, then all of a sudden, then JP Morgan says something like, okay, look, we need to reevaluate all this stuff. We're going to do this and this and this and this. And then that put a drain on Lehman's finances. And then, of course, we all know how that ended. How about with Bear Stearns? This is a little bit of a different problem. Unsecured commercial paper before 2007. However, all right, so what did I just say? We got this instability in the repo market. So Bear Stearns enters the repo market during periods of uncertainty. So whenever you got this extra volatility, what do lots of wise men and women say? Boy, nothing good can happen from all of this. All right, so initially, Bear Stearns posted high quality collateral, locking in these favorable results. But by the end of 2007, things changed dramatically. And so acceptable types of collateral grew thin, right? So some people would say, hey, how about I'm using this financial calculator that Jim sold me in several recordings ago in a forward contract, right? That started to go out the window. So only super high quality collateral was acceptable. Haircuts increased, and then the repos, right? They used, what did I say? They could go to, 6 months or 12 months, but now they're winnowing down. And so what happened in the repo market is that the participants in the market refused to kind of roll over those trades. Remember, if these are, 2 days or 4 days or 1 day, try to roll them over. And so there was a run. How about that learning objective on collateral? We've spent some good time talking about collateral, and we should know this, right? Two forms: specific collateral, in which the seller must deliver a specific asset, right? And that's with the International Securities Identification Number. That's what I was talking about earlier. So exactly, right? I think is it a 9-digit number? I think it's, and so you exactly know which security it is, as opposed to general collateral repurchase agreement, in which you just, it's like going to the food store when you have a bunch of, you have fruit, you got, pears and peaches and apples and bananas in there. And so you can allow the seller to pick from among all of those fruit or among all of these, let's say high quality securities. Look at the block points down at the bottom. So sovereign debt, supranational debt, Eurobonds, and money market instruments. Of course, money market mutual funds are huge participants in this market. And, if you think about it, what do money market mutual fund managers have? They invest in lots of treasuries and commercial paper and bankers' acceptances, and they have lots of cash. So they could actually be, kind of on both sides, but they tend to be on the providers of capital in this repurchase market. And then I like this last block point there. Security provider may have the right to substitute equivalent collateral. I like that because it gives, essentially an embedded option in there. But we need to make certain that we define what is equivalent collateral, because I might say, oh, this calculator, that's equivalent, and you may not agree with that. All right, let's get up to the last learning objective or two, where we're talking about these spreads. So let's take the difference between the general repo rate and the special repo rate. So general is the lowercase r, uppercase r is the special repo rate. Of course, lowercase r is going to be higher than uppercase r. And in fact, S should be greater than or equal to 0. Look at the orange teardrop point. Competition to buy or borrow a special drives down that special repo rate. I think this is really fascinating because then skip all the way to the bottom two. Look, a special rate of 0% implies the trader provides free financing in exchange for receiving that desired asset. All right, so look, yes, interest rates are 0%. Now I know, in the last years, we've had interest rates that are very, very low. But when you get interest rates that are exactly zero, you get into some territory that you have to scratch your head over and think, okay, what does it really mean? What does it really mean if interest rates are zero? Who's paying whom during this scenario? Here's a really good slide that summarizes what I was talking about in my original example, right? Repo spreads are tied closely to U.S. government Treasury auctions, of course. Now, this part of the learning objective implies that you understand the relationship between those two, which I explained before. But I thought was interesting, and I always find this interesting, that institutions and traders and others in this industry, in the repo market, are so concerned about liquidity that they differentiate between the on-the-run issue, which is this, the current issue, like, what's today? Let's suppose today's Monday, so the Treasury is going to issue a bunch of Treasury bills today. So those are on-the-run issues, as opposed to those issued last week or the week before, or the month before, being off the run. And so this is a perception that those on the run issues are the most liquid. So they're in the most high demand. And so of course, borrowers and lenders in the repo market, they flock to these on the run issues. How about if we look at this illustration regarding the spread? Now look at the vertical axis. This is the spread, and we've got the 5-year notes and the 2-year notes. But look at the horizontal axis. This is a little bit unique here. So we go from business days to the next issue. So 0 is all the way out there on the right, where usually 0 is over here on the left. So let me just make sure I understand this. So we're starting with 22 business days. So that's another month, right? Let's say. So 22 business days until the next issuance. So note that the spread on 2- and 5-year notes is about the same when these on-the-run issues are exactly issued, right? So those orange line and the dotted blue line, they pretty much converge there at the beginning and at the end, which is essentially the same time period if we're rolling over these. But note there's a widening there somewhere in the middle, and notice the gray area in there where there's kind of like a peak, right? And so this is the area where there is the announcement of what we're going to do in another 2 weeks. And so we're trying to determine whether or not there's good substitutability or bad substitutability. And of course, when I say good and bad, I mean Treasuries are all good substitutes for each other, but they might not be perfect for the design of a special kind of a repurchase agreement. And how about quickly that very last learning objective about financing? And so let's go ahead and first look at the two main advantages. This is probably a good exam question here. Liquidity advantage, right? And financing advantage, right? So those are two obvious advantages. So let's suppose we have an on-the-run special issued January 1st. It's trading at a spread. Now it's a special spread of 0.15%. Let's see, we're going past June 30th, so January 1st to June 30th, so that's 6 months. Determining the financing value per $100 of market value. And so this is really a simple mathematical question, right? You got 100, you have the 15 as the decimal, and you're doing this over 6 months, so 15 cut in half. So there's the 75. You probably didn't even need that formula there, but there it is at the bottom in the solution. You take $100 times the 15%, and then you adjust it by time. 180 over 360 is 2. So look at the interpretation there. If the holder lends out the special and invests the proceeds, they will earn what is that, 7.5 cents per $100 market value of the special. And that takes us through our learning objectives. Notice that we covered those first three in my example. So if you understand that example, or pretty much covered those, if you understand my example, you ought to be able to answer those kinds of questions. I would also focus on those real life examples, but I would also be able to do some of those simple calculations there.